Hello, my name is Anton Kolonin. Today I am going to present the work done by our team, including people from Singularity DAO, Singularity Net, and the Autonio Foundation. And our work is about creating the technology for adaptive multi-strategy market making agent for volatile markets. In particular, we are going to talk about the market making agents for Binance, which is centralized exchange for cryptocurrencies. And our work is based on our earlier developments presented on different conferences on architecture of automated crypto finance agent and adaptive multi-strategy market making agent, which was presented on the AGI conference in the year 2021 last year. And now we are extending our work for studying how the adaptive multi-strategy market making agent can perform on volatile markets. Here is the architecture of our market making architecture. And by market making architecture, we mean trading on the centralized exchange using the limit order book system. So we are talking about the agents which sit on particular trading pair or particular market like BTC USDT or Ethereum USDT and create bid and ask order for buying and selling assets, and they earn on spread. So the basic policy of the market making agent is sell high and buy low, and they might be selling and buying at the same time, just using multiple orders. And in fact, the same agent may create and maintain different limit orders on the same market at different levels of the price using different spreads. And when the same agent is keeping multiple orders, that means order grid. So the agent keeps the grid of the orders at different price levels, trading all orders at the same time. So here is our infrastructure and the design of our multi-strategy market making agent. In the middle, we have the adaptive multi-strategy agent, which can be thought as a controller. And controller means that it doesn't trade itself. It just creates two different armies or populations of single strategy agents which trade in different ways. The first way of trading, which is created, which is implemented by small amount of single strategy agents, is real trading on the real exchange. So on the right, we see a little swarm of agents which are controlled by the controller, and they trade on the real exchange, doing the real market making with real money, and they just report the profits and losses to the controller. At the same time, controller creates another army, much larger army of the single strategy agents, which trade on virtual environment. So they do virtual market making on simulation and backtesting framework that we have created for this purpose. And also the controller agent selects the different strategies to be implemented by these multiple single strategy agents, and it collects the virtual profits and returns returned by these agents. And of course, behind the scene, there is a flow of market data being collected from real exchange to simulation and backtesting framework, so we can actually execute this virtual market making on the to simulate the market making activity. Let's see how it works in such illustration. Here you see multiple levels of bands. So here you see from left to right, you see 4 bands, and each of the bands correspond to what we call strategy evaluation period. In this example, we have the strategy evaluation period equal 2 days. Like the first band is October 1st to October 2nd, 3rd. The second band is October 3rd to October 10th. The third band is October 3rd to October 5th. And the fourth band is October 5th to October 7th. So each period, strategy evaluation period is 2 days. Now the there are two halves of the screen. So on the top, you see four bands that correspond to virtual market making. And on the bottom, you see four bands which correspond to real market making. And each small band in upper half and lower half corresponds to profits and losses of one individual agent implementing its own individual strategy. For example, on the left you see the list of different strategies run by different agents. At the very top you see the hodler. So you see the virtual hodler, which holds virtual funds and that corresponds to the first line of bands. And at the bottom you see another hodler, which is kind of real hodler, which holds the real funds. Okay, and so you see in one period real hodler loses a lot, and then it earns a little bit, and then it loses a lot. Then what you can see here is that on the first period, which is the first series of bands on the very left, all virtual agents start to do the market making. So they create orders accordingly to their own strategies, and they get some profits and losses. Because this is the very first period, we don't have any real agents on the bottom doing any trades. So we want the first evaluation period to run before we select the strategies which correspond to the current state of the market, so we can actually make selection of the agents to be used for real trading. And by the way, in our configuration, we have about more than 20 agents doing virtual trading, and our configuration makes it possible to select only 4 agents, or let me see, 1, 2, 3, 4, 1, 2, 3, 4, 5, 6, 7, 8, and only 8 agents doing the real trading. And we only select the agents which can make the profits during the previous evaluation period. So on this first evaluation period, we can see that some of the agents are making profits, like this agent with the spread 0.4. By the way, the numbers that we have indicated for agent strategies correspond to the profits, to the spread. So 0.0 is 0 spread, 0.2 is spread of 2 points, 0.4 of 4 decimal points, and so forth. And the other words correspond to different cancellation policies, like what is the activity of the order cancellation. So same agents, like phlegmatic agents, are canceling the orders only when phlegmatic agents are never canceling the orders till the orders are executed till the very end, and sanguinic order agents are canceling orders only when the price direction changes, like goes from up to down and from down to up, and they cancel ask orders or bid orders and create the orders on the other side of the spread if the price direction changes. And the choleric agents are always canceling new orders whenever the price changes. So just 3 different cancellation strategies. So the combination of the order cancellation strategy and the spread defines the specific agent strategy. So we select some of the strategies that appear winning at the previous run, and we get the agents placed in the pool for doing the real market making on the next evaluation period. And during the next evaluation period, we see which agents are performing well on both the real market making and backtesting on the historical data that we collect from the exchange, and we can evaluate. So in this case, we see that the selection of this agent with 0.4 was quite good, because this agent returns pretty good profits, and the second agent with spread 0.6 also returns really good profits. So what we do next? Next, we consider that the agent with spread 0.88 tried on backtesting is expectedly returning good profits. And we select this agent to be involved as part of the real trading on the next iteration. And we also select another agent based on the previous backtesting to perform this actual trading on the next iteration. Unfortunately, when we move to the third period, we see that one selection of the agent based on the backtesting was right, so this agent is winning, but the first selection of this agent was not good, so this agent is losing. So we are not always lucky, but on the next round, before we are going to the next round, we select again the profitable agents based on their performance on backtesting, and we did it right. So the agent selected on the previous period is getting really good profits. So what we do here is that we are gradually shifting the focus of our backtesting on the historical data using the full population of agents implementing all imaginable strategies, and only the winning subset of agents are allowed to do the real trading with real money. So that's how it works. And now let's move to the extended version of experiment that we have run this year. To see how our technology can scale up with different market conditions. First of all, we have explored different sorts of agents. So the first type of agents is called base, and that's very simple family of strategies implementing simple buy low, sell high rule, with the only parameters driving the strategy is the size of the spread and the order cancellation policy that I have explained when discussing the previous slide. And then two other families of agents are Neox agent, which is being created by and maintained by Autonia Foundation project, and the Hummingbot is the bot maintained by the open source Hummingbot project. Also, we have used the hodler strategy, but the hodler strategy was used just for reference to implement the buy and hold all the time policy. Using these strategies, we have tried few different sorts of markets from the historical data. Each historical period corresponds to 1 month of years 2020 and 2021. And 1 month is showing the bull market with low volatility. Another period corresponds to bull market with high volatility. And the third period corresponds to the bear market with medium volatility. And we have run two different suites of experiments. The first one was based on 1 hour data, by 1 hour increment between the order updates. So 1 hour means that every hour the agents implementing the respective strategies were reviewing their current orders and making decisions whether to reopen the orders or to keep the current orders being executed. So let's see what we have on different markets with different families of agents. The blue agents, the blue bars correspond to the hodlers. So we see that on the bull market periods, all the hodlers are winning, and on bear market, all hodlers are expectedly losing. And the numbers on the bars correspond to return of investment in percentages. Like in the first 2 months, all hodlers are winning about 10%, and in third month they are losing almost 20%. Now, if we try to use the the base agent strategies, very simple ones, then we can see that for the bull market, the base strategies are not very consistent. So like here we have the positive alpha, so returns are better than the returns of the hodler, but in all other cases for the first month, bull non-volatile low volatility markets, the alpha of orange bars is less than blue bars, so the alpha is negative, so base agents are not working well for this. If we consider bull market with high volatility, then for two different periods of the strategy update, by the way, to note what is the difference across the rows with different bars is that upper row of bars correspond to the 1 day used to update the strategy, so the round of reassignments of the agents from the set of from the pool of agents doing virtual market making to the smaller pool of agents doing real market making, the period of reselection of the agents was 1 day. And so the second row corresponds to 2 days, third to 3 days of population update, and fourth row corresponds to 5 days period of agent set update. And we can see that for the NEOX agents, which is about orange bars, for one period configuration, the alpha is positive, like 1 day and 5 days, and for 2 day and 3 day periods, the alpha is negative, and the agents are even losing, so not quite impressive compared to hodlers, which is always winning. And for the bear market, we see that the alpha is always positive for the base agents, and in most of the cases there is even positive return compared to great losses being taken by the hodler. But still the other agents are getting much greater returns. Now let's consider what's going on with NEOX agents. So we can see that on the non-volatile bull market, the NEOX agents are always losing. With high volatility bull market with small period update like 1 and 2 days, NEOX agents are always also losing, but they are winning significantly on the 3 and 5 day period updates. Update periods. And finally, if we consider NEOX agents for the bear market with medium volatility, we see that they in any configurations or any of configurations of period, the NEOX agents are getting the profits and positive alpha, and in most of the cases the profits are superior to any other agents. And finally, if we consider red bars, and the red bars correspond to hummingbot agents, then we can see that they provide mostly stable and reliable performance, being superior in terms of both return and alpha for medium column, where we have the bull market with high volatility. Then we have positive alpha, positive return on any of the period configurations, and positive alpha in one of the period configurations for bear low volatility market. And again we have positive return and positive alpha for the for the bear market with medium volatility. So here are the conclusions that we have just discussed, and another experiment that we have run with 1 minute step for data experiment. So 1 minute means that the agents, each of the agents in both of the populations, were updating their orders every minute. So that's that is what is called refresh rate in bot technology normally. So let's see what we have in this kind of simulations. We have see the same profits and losses experienced by hodler. We can see that for bull low volatility market, most of the hummingbot and NEOX agents are losing, and hummingbot is having positive returns in most of period configurations, starting including 2, 3, and 5 days, and hummingbot even has positive alpha with long period for 5 days. If we consider bull market with high volatility, then Hummingbot is always having positive alpha and positive return, superior alpha and superior return. Hummingbot, that's Hummingbot. Then New Maker Green also have positive return and except 1 day configuration. And in 2 days it even has positive alpha, and the base agents are always losing compared to hodler and any other agent strategies. And finally, if we consider the medium volatility bear market, then all agents are having positive return and positive alpha, and just we see different champions on different period configurations. So all that says, so far it looks like our oversimplified base agent strategy, which was explored in the last year, seems less superior and less well-performing compared to Neox and the Hummingbot. And the Hummingbot kind of agent strategy appears the most superior across different kinds of markets and across different refresh periods used to do the order update by the agents. So now let's consider what, let's keep some tables that we use it to get this data, and let's summarize which problems we might have with experiments. First of all, we have found that decreasing the period of strategy update makes the results less stable and less profitable. And one suspect is that that's due to our current strategy of handling the orders, hanging orders. That means that if there are some outstanding orders at the end of the evaluation period, then even some agent is reselected for the next period, we cancel the current orders being maintained by this agent, and we create another instance of this agent with new orders, and that might be a problem. So improvement of our further work might be that we implement the hanging orders. So if the agent if an agent is reselected to perform in the next period based on its performance in the current period, then all orders created by this agent are kept on the limit order book. Also, we might have different issues with the Hummingbot. So might be the internal implementation of our Hummingbot simulator, because what I'm describing was done based on the simulations. So far we didn't do trading on real markets. So all what have been done in our simulation and backtesting framework. So in fact we were doing the simulation and backtesting in the simulation and backtesting. So a kind of simulation in simulation experiment so far. And our simulation of Hummingbot might be not quite reflecting the real policy of the fund allocation across the different agents. So the Hummingbot might have some competitive advantages across the different agents. But that's not the bad thing about the Hummingbot. Might be that if we could this strategy, asset allocation strategy implemented for other agents, they might be performing better. So different agent strategies were not quite aligned. And also the initial set of configurations for Nuox agents might be a little bit biased towards bear market. So might be if we could use a more diverse grid of the parameters for Nuox agents for this experiment, might be the performance on the bull markets would be better for them. So possible improvements that we might make in our further work: make more dense and regular bid-ask spread grid for the experiment. Also play with different amounts of sizes of order amount for base and quote currencies for bid and ask. Then implement the hanging orders option that I have mentioned, so the orders are not cancelled for the agents re-elected for the previous period. And also have extended versions of the Nuox agent implementing this hanging orders option in New York's and implementing some advanced hummingbird strategies other than pure market making. So far, the experiment that I have discussed was based on the simplex hummingbird strategy called pure market making, but it has more advanced strategies which might provide even better results. Regarding the controller agent architecture, there might be few different improvements. So we may fine-tune the agent selection policy, like the agents which perform on the real market making might have some preference to be selected for the next period compared to the agents that were evaluated based only on the backtesting. Then also we might prioritize the funds distribution among the agents, like the agents who have earned more money on the previous round might be allocated more funds to perform on the next round. Maybe it would increase the alpha for each of these for the winning agents and for the whole population of agents under control of the single adaptive multi-strategy agents. Then, as I mentioned, we might have more dense grids for period fine-tuning. For further analysis, implement that hanging orders option, so the hanging orders are kept through the evaluation periods. Also adding the prediction stuff, so make agents capable to make long-term price prediction as well as short-term price prediction. And finally, we might imagine that there might be a complication of the whole architecture when there is a super adaptive multi-strategy agent which controls the population of the junior adaptive multi-strategy agent, which are in turn controlling the third level of populations of single multi-strategy agents. So all that says, the major takeaway is that, as we have seen, market volatility is your friend. So the greater the market volatility is, more money you can get, you can earn using the market making on the limit order book system using our adaptive multi-strategy agent technology. So volatility is your friend, but you just need to cook it properly. So thank you for your attention, and get in touch with us if you want to learn more about this. Thank you. Bye.